a lot of people invest, but a lot of people have had like really, really nasty experience. A lot of people have lost money. You know, every form of investment comes with a particular risk. People have lost money, people have made money. You know, some people, when you tell them invest in this, their first thought is a scam. You know, when you tell people invest in equities, a lot of people tell you it's a scam, and they might have their reasons. Maybe in the past they have had people that had invested and then had lost money. Investment comes with risks. That's the truth. But it's a bigger risk in the world we live today not to invest. You know, and you know, when people say equity is a scam, you lose money. Sometimes if you have history knowledge of what has happened in the stock markets, you know, previous stock market crash, you would understand what they're saying. Maybe because okay, I remember in 2020 was when the COVID came. You know, Nigerian stock market, I think across the world the stock market went down. You know, you can imagine somebody, I bought my Zenith for 19 naira. Zenith went down to 12 naira. So you can imagine somebody that have $1 million naira worth of stock. You know, your stock was worth 19 naira and it's now 12 naira. It's almost like seeing the valuation of your money goes from 1 million to 120,000. You know, it's amazing and it's scary. But with knowledge, with understanding, you can also make that money back. Because for me, that stock market investments ended up in a positive. I actually made money. You know, it's weird. Someone say, how did it? Because when the market went down, we averaged down. We averaged down with the market. So it gave us an opportunity to reduce the cost at which we were buying the shares, because the shares were now available at cheaper price. So we put in more money. You know, it's a bit scary that our money is going down, but we put in more money and that's what we are going to be looking at, because there's some what you consider and the kind of investment you make, such that even in downtimes, economic downtimes, you're making money. Even when economy is at good season, you're making money. Even in recession season, I'm making money. Some people have come to understand this, and so at all times, you know, they're always making money in the market. Somebody is always making money in the market. That's the thing. There's always an opportunity in every side of the market, you know. And that's what we'll be looking about, what you need to consider as a person so that you don't lose money as such. Classification of investment. So there are different classes of investments. If you would have seen, there are different classes of investments. We have conservative or low risk investments. We have medium risk investments. We have high risk investments. So as the name implies, it gives an idea of what those investments are. So conservative investments or low risk. They are low risks. The risks associated with investment like this are very low. For some of these risks, your capital is guaranteed. There's no way you lose your capital. When we talk of capital, we're talking of what you invest. So if you invest 20 naira, that 20 naira is guaranteed. You know, you would get that 20 naira. It's almost like a savings account, but with a little upside, with a better upside. They give better upside than a savings account. So they're adding money, as in, let me say, there's a bit of more advantage than a savings account. A savings account, your money will be there. Do you get? But when you do something like a mutual fund, your money is also there. You can access it most of the time at any time you want. But there's the upside of a better returns than a savings account. So they are low risks, but they're also low returns. So maybe their returns might be, it's just that they're better than your regular savings account. So because their returns are most times based by CBN lending rates or treasury bills rates, because that's what most of them invest in. So when we talk about conservative or low risk investments, these are risks that they are low risks, but they are low returns. Your capital is guaranteed. Examples of this is FGM bonds, treasury bills, mutual funds, fixed deposits. Truth be said, everybody should have a low risk investment. When you are designing your portfolio, your emergency funds, when we call emergency funds that, okay, some people say emergency as the word, if you need to do an emergency, no. You need money that is liquid, that you can easily just get. Those are the kind of money you put in low risk investments, because you can easily access them, and those cash are sure. So also I think for me, for groceries, it's a way to save for groceries, for rent. Those are not things that happen immediately. Those are expenses that are recurring, but they don't just happen to you. They must happen. You must pay your rent, you must buy your groceries, you must pay your children's school fees. So this is a good way for you to save to them. Medium risk investment, as the name implies, is medium risk. So it's in between low risk and high risk investments. So it's just medium. It gives a better or a slightly higher rate of returns than your low risk investment, but less than your high risk investment. Unfortunately, your capital is not guaranteeing most of this kind of investments. There's no guarantee of your capital, and so you are careful the kind of money you put in here. You don't go and put your house rent here, you don't go and put your children's school fees here. Do you get? But the good thing about medium risk investments, some of them, is that with any investment as such, with understanding, with knowledge, with research, you can actually reduce the risks. And you'll be surprised that any investments can become risk-free, even an investment with an higher risk. I listened to somebody say something today about a combination of investments that will give you an upside, but also reduce the risks. A combination of a low risk and a medium risk investment can give you the perfect average. A low risk and an high risk investment in a good percentage distribution can give you the perfect medium risk investment that you need. So with knowledge, with understanding, this can be done. Examples of medium risk is commercial papers. So commercial papers, real estate, equities. So when you talk of commercial papers, like we always said in our previous class, these are like companies borrowing money from the public, like the government borrow with treasury bills, they borrow with commercial papers. But you can reduce, because it's company and it's not government, it's not guaranteed, but you can reduce this risk by buying commercial paper of highly reputable companies that have track record. Not just any company, but companies that have track records. You could do this by look at your house. What are these food stuff that you always buy? Are these companies in the NGX? If they have commercial paper to give you, maybe you should buy, because these are companies that people use their products, and so they won't just disappear like that. They give medium risks, slightly higher than the low risk investments. So they give medium risks, but they're not bad. So maybe you're looking at risks slightly above inflation rates, which preserves the value of your money. Real estate is also a medium risk investment. Do you get? So your real estate, I would classify real estate as medium risk actually, because it's a medium risk investment. Because it's a medium risk investment, in the sense that your real estate, your house is a depreciating asset. Whether you want to agree or not, your house is a depreciating asset. Build a house and don't maintain it, the paint becomes faded, certain things begin to break and crack, and because of weather, not even use, because of weather, such things you now need to maintain. So real estate is a depreciating asset, and so even if it is appreciating in value, it is also depreciating. So the value is depreciating and appreciating. The land is appreciating, the structure is depreciating. Do you get? So because of that, real estate is a medium risk investment. Do you get? Also, your house could result in there could be fire accident and all those stuff. You could buy a wrong land or something. So those things they are medium risks. Do you get? Those risks exist, but like we said, the thing with any risks is that with good research you can avoid those risks. So even a high risk investment can become a very reasonable investment to do with the right information and knowledge. Equities, some people will say equities is high risk, but I would say equities is medium risk. It's medium risk because with good understanding, there are different stocks. If you are buying exchange traded stocks, exchange traded fund, like we said in our last class, that's definitely a medium risk investment. Buy an S&P 500. Google it, look at the S&P 500 returns over the last 20 years. you'll be surprised it has beaten the market and it has been positive. Do a compounding on that for your money. You know what you're dealing with. This is in USD. For emerging countries like us, if we have a steady USD returns, we are always excited about it because it preserves the value of our money and gives us a bit of returns or upsides on the other end. So these are things you consider. Medium risks, they have medium returns. Aggressive or high risk investments, as the name implies, they are very high risk investments. At one time, Bitcoin was an high risk investment when it first started. You know, it was a new technology, a new, well, it's a currency now coming, and nobody knew much about it. It was at the introduction stage. Nobody knew if it will even last because many investment like that has come without it. But now you would not really say some cryptocurrencies are actually high risk. But you will not call, I wouldn't classify Bitcoin as high risk. I would classify Bitcoin as more of a medium risk, you know, even because when Federal Reserves of company have begun to stock, it's the way they stock gold or the way Nigeria stock USC as its external reserves. That's how US now is also keeping storage of cryptocurrency, storing its money in cryptocurrency, because the world is looking at the future and is saying that digital currency is the way to go in the future. So might be the way the future will tilt to. So because of that, highly reputable countries are looking at saving their reserves also in crypto, at least exposing themselves. So, and most of this, I'm sure a lot of them will look at Bitcoin. But yeah, crypto can be high risk because there are also meme coins that a lot of people buy. Do you get? And you buy meme coins that has no track record. Somebody just, I heard that carrying USD, they mint coin. You know, not sound decent or anything, but you know, it's a risk as such associated to it. I think during the US election, I think they also did one for the president. Yes, a lot of people saw gain, but a lot of people saw losses from it. So when the downside of the stocks came by, so yeah, equities too can be risks, because if you're buying penny stocks are highly volatile, but they offer you high rates. That's the thing with high risk investments. High risk investment gives you high returns. Venture capital will be the next one I would look at in terms of aggressive risks. Venture capitals are people coming together, pulling funds together and then investing it in, pulling funds together to invest in startups. Like the name involves, is startups. There's no guarantee. These are entrepreneurs that are just starting businesses. They could make it, they could not make it, you know, there's that risk that is attached to it, you know. Statistics doesn't also favor startups, saying that 8 in every 10 startups don't make it, you know. Some startups never go beyond a particular capital valuation, but so when you invest in them, some also have gone so big. So I remember there are funds that were put together, and venture capitalists actually sponsor companies like Bamboo, Trove, you know, Triva Greek, or those kind of companies. There are funds that actually sponsored them, and today those companies, so most of those fintechs, you know, they're sponsored by venture capital. You can see what most of them are doing, you know, but not all of them are nice stories, because out of every 10, maybe like 1 or 2 will become a success. So when you're putting your money like that, you know that. But the thing with high risk investment, like I think, is that because they're high risks and they're high returns, you don't need like 10. Imagine if one gives you like 100x. Do you know what it means for you to have $1,000 and then you get 100x? If you have like $10,000 and you put in 10 venture startups, and then you get a paystack story or an Andela story, you know, you get your 1,000 coming to 100x, you know, that's like $100,000. That's crazy, you know. So what I always advise is your investment portfolio should be such that it is distributed. You know, you have high risks, you have low risks, you have medium risks. Expose yourself. Mathematically, you can do such that you're preserved. Your capital is preserved.